What's happening, everybody? Hope you are enjoying your day. I want to talk about inflation and just kind of U.S. inflation and the most recent numbers for inflation and how that affects like investing outlook, energy prices, that sort of thing. And I'm going to use AI to kind of help with some data, the most recent data, and go from there. And also get a little bit of the AI's take on how it might affect my investing style, which is interesting because, I don't think that I've shared how I invest on Copilot much or on the with the AI. So I don't know if Microsoft is I've kind of um, I'm wondering how the AI is picking up on my investing style. So somehow it is, whether it's it knows what I invest in based on when I signed into my brokerage account, or it just kind of knows what I research and what I learn, and so it makes assumptions. I don't really know. Anyway, so yeah, I asked AI, could you discuss the most recent inflation numbers in the United States? Answer is the latest U.S. inflation data covering June 2026, released July 14th, shows a meaningful cooling in price pressures, driven almost entirely by a sharp drop in energy costs. The most important headline, CPI fell month over month, and year over year inflation decelerated to 3.5%, down from 4.2% in May. Key takeaway, inflation eased significantly in June 2026, with headline CPI at 3.5% year over year and minus 0.4% month over month, while core inflation, excluding food and energy, slowed to 2.6% year over year, the closest it has been to the Fed's 2% target in over a year. So core inflation, 2.6%. It's not too far off from Fed's target. Some of these numbers were released before the United States kind of, some of the government officials ordered some more strikes in Iran, and there's been some more hostilities in Iran and disruption in the Strait of Hormuz, and disruption in the Strait of Hormuz causes uncertainty about the movement of oil through the strait, and that causes inflationary pressures on the prices of oil, and so as the oil price increases, the gas prices increase fairly quickly. The um, the converse of that is true as well. However, when the oil prices drop, it takes a bit. There's some lag in the gas prices dropping for some reason. Um, so a lot of times when the stock market reacts right away, but the gas prices in the United States takes a little bit of time for them to drop after oil prices drop. So look at headline CPI for June 2026, negative 0.4% month over month, largest drop since May 2020, and positive 3.5% year over year. This decline was driven overwhelmingly by falling gasoline and fuel prices as geopolitical tensions temporarily eased. Core CPI, underlying inflation, 0% month over month, flat, positive 2.6% year over year. This is the number the Federal Reserve watches most closely. A flat monthly reading suggests underlying inflation pressures are genuinely moderating. Energy prices, the big story. Energy saw a dramatic decline. Energy plus 15.7% year over year. Still high, but falling fast. Gasoline plus 26.7% year over year, but sharply down from May. June's drop came after crude oil prices plunged when peace talks with Iran briefly reduced supply shock fears. Shelter and services inflation. Shelter remains sticky, a major reason core inflation hasn't fallen faster. Shelter plus 3.3% year over year. Rent plus 2.8% year over year. Owners equivalent rent plus 3.3% year over year. Transportation services also remain elevated. Motor vehicle maintenance and repair, plus 7% year over year. Airline fares, plus 26.5% year over year. Food inflation. Food inflation continues to cool. Food overall, plus 3.0% year over year. Food at home, plus 2.7% year over year. Food away from home, plus 3.4% year over year. Notably, dairy is nearly flat at plus 0.4% year over year, while fruits and vegetables remain elevated at plus 5.3% year over year. Vehicles, a mixed picture. New vehicles, plus 0.5% year over year. Used cars and trucks, negative 1.8% year over year. Continuing normalization. What this means for the Federal Reserve. Markets interpreted the June CPI as a sign the Fed may pause rate hikes. Probability of a July rate hike dropped to 15% after the release. However, the Fed remains cautious because shelter inflation is still above target. Geopolitical risks, Iran conflict could push energy prices back up. Social Security COLA implications. July CPI data used for COLA calculations has led analysts to project a 2027 COLA of 3.8%, though this will change as August and September data arrive. Bottom line, inflation in the United States is clearly cooling, driven by a sharp reversal in energy prices and a flattening of core inflation, but shelter and services remain sticky, and geopolitical risks could reverse progress. For now, the June 2026 CPI report is the strongest evidence yet that inflation is moving back toward the Fed's 2% target. And so I also looked at I wanted to just out of curiosity I wanted to discuss how this affects markets, rates, and your investment strategy. Like I said, I don't know how Copilot knows my investment. I haven't really shared my investment strategy on I will share. I'm kind of a long term investor that mostly ignores what happens in the short term in the market. I have sometimes I struggle finding I basically do I try to invest dollar cost average into the markets, mostly in equities, and I try to do that over the long term, and also Bitcoin, and sometimes gold. Those are the and then I hold a bit of a cash position as well, or a treasury bill position, one of those two, and so yeah, I'll make interest on that, and then I'll hope for the equities. They have I keep those for usually greater than 5 years. Usually the longer you hold equities. The data shows the longer you hold equities, the better chance you're going to have to do well. And anyways, so I definitely keep ETF baskets, bundles of stocks, large cap, mid cap, small cap, S&P 500, Nasdaq, and I also got a position in Bitcoin as well, currently. But anyways, so the market impact, the market reaction to June's softer CPI was immediate. The 10-year Treasury yield fell 6 BPS on release, signaling relief that inflation is cooling. Odds of a July rate hike dropped from 47% to 17% within minutes. Equities have remained resilient even in a higher rate environment because earnings growth, not speculative valuation expansion, has driven the rally. This makes the rally more durable, but also more concentrated in AI-linked mega caps. Bonds. Higher yields earlier in Q2 made bonds more attractive, and June CPI print reinforces that short duration treasuries, 2-year at 4.92%, offer strong carry with limited duration risk. Falling yields post CPI increase the risk of the value of existing bond positions. Gold has rebounded toward $33.90 per ounce, functioning as a hedge against structural inflation and concerns about Fed credibility. 2. Interest rates and Federal Reserve outlook. The Fed is now boxed in by conflicting signals. Before June CPI, markets were pricing rate hikes, not cuts, due to earlier inflation reacceleration driven by the Iran conflict. After June CPI, the soft reading sharply reduced near-term hike odds, but policymakers insist one good month isn't a trend. Core services inflation remains sticky. Shelter, hospitality, wages. Bottom line, the Fed is likely to pause, but not cut until late 2026. Options markets now price the first cut in December 2026. What this means for an investment strategy. Given your analytical style and preference for long-term evidence-based positioning, here's how the current environment shapes a rational strategy. A. Equities. Stay invested, but shift toward quality. Earnings-driven markets favor profitable, cash-generating companies. AI-linked megacaps continue to lead, but concentration risk is rising. Consider tilting toward quality factor ETFs, high ROE, low leverage. Bonds. Increase exposure to short duration and select intermediate. Short duration treasuries, 4.9% yields, provides strong risk-adjusted returns. Intermediate treasuries benefit if yields drift lower on continued disinflation. Avoid long duration unless you're explicitly betting on a recession. C. Credit. Be cautious. High yield spreads greater than 360 BPS do not compensate for refinancing risk in a high rate environment. Investment grade corporate bonds are safer and still offer attractive yields. Commodities and gold. Gold remains a valid hedge given geopolitical volatility and sticky services inflation. Energy exposure should be tactical. Prices are highly conflict sensitive. E. Housing and real estate. Shelter inflation is still elevated. OER plus 4.8% year over year. Higher long-term rates pressure commercial real estate valuations. Residential real estate in stable markets like Springfield, Missouri, remains supported by demographic demand. Number 4, synthesis. What a rational investor should do now. Most important moves. Number 1, maintain equity exposure, but emphasize quality and earnings strength. Number 2, increase short duration treasury exposure for safe yield. Number 3, limit high yield credit due to refinancing risk. Number 4, hold some gold as a hedge. Number 5, avoid long duration bonds unless expecting a sharp economic slowdown. Number 6, stay diversified. Inflation volatility remains tied to geopolitics. So yeah, I'm gonna continue doing what I do, and what I do is I have, I would say, yeah, I would say about 60% in equities. I have a higher percentage in Bitcoin than I probably want to right now, but I'm dealing with strategies to I actually think Bitcoin is going to be fine long term. In the short term, it's hard to know how long the Bitcoin winter is going to be, and so it's hard to know when the sentiment is going to be more positive, and when it is, you want to be in the market and you want to have because sometimes Bitcoin can jump 20-30% in a day, and so I actually think I'm gonna keep my Bitcoin. I'm not gonna sell Bitcoin right now unless I have to, and I don't have to, and so I'm gonna continue holding Bitcoin, and also keep putting more money into my equity positions, and I actually might I was thinking about maybe taking some advice of the the AI, and maybe holding a bit more gold, and also possibly increasing short duration treasury exposure for safe yield. That's another possibility as well. Like something like TBIL, that might be a possibility. Hold more of that, or even maybe some bonds. We'll see. The next thing I want to know is what's the next inflation report coming, or when is the next inflation report coming? The next U.S. inflation report, the July 2026 CPI, will be released on Wednesday, August 12th, 2026 at 8:30 a.m. Eastern Time. This report will cover July 2026 inflation data. After that, the following CPI release is Friday, September 11th, 2026 at 8:30 a.m. Eastern Time, covering August 2026. And so my guess is that the Federal Reserve, I don't know when they met it. It's like I think 8 times a year. So they'll probably be meeting sometime. My guess in early September, maybe mid-September. But they're going to be the Federal Reserve is going to be using the numbers from the July 20 this report on 812, and then also on September 11th for their next decisions. So quick reference: upcoming CPI release says 2026, 8/12, 2026 July CPI, July 11th, 2026 August CPI, October 14th, 2026 September CPI, November 10th, 2026 October CPI, and December 10th, 2026 November. So it's basically not quite the middle of the month. Every month is the previous CPI release, and yeah. I just wanted to share my thoughts. I give kind of my investment strategy on how I'm mainly a long-term investor. I don't if the Federal Reserve increases interest rates 25 basis points, I'm not going to panic. I'm just going to keep doing what I do, and if they keep it the same, like this AI is trying to suggest they might. I don't know if that's accurate or not, but they might keep it the same. I'll keep my strategy. If they decrease the interest rates, then I'll still keep my same strategy. So as long as they don't do anything like completely drastic in one direction, then I think everything's fine. And there's a lot of there's 12 members on the board on the Federal Reserve, and so I'm not too worried about it. They voted on it. I guess 3 of them voted last time to increase the interest rates by 25 basis points, and 9 of them said keep it the same, and so they kept it the same. So it's not really a one-person decision; it's more like a vote. And I still think that either way, if it goes up, 1 or 2 points, it goes drops 1 or 2 points. The equities are a good position to be in long term over 5 years. Even when the interest rates went up over 5% under the last presidential administration, the stock market still went up as well. So anyway, hope this helped, and I hope you enjoy your evening. Adios.